Hi, everybody. Welcome to the podcast. Today we have Rocco Marrapodi, our head strategist, and our lovely co-host, Amanda Calabria. Guys, thank you for coming on.
Thank
Good
you.
to be back.
All right, so today we're going to be talking about what actually happens during an interest rate cycle decrease when rates are coming down. A lot of people assume that that is when confidence returns to the market or that is when relief will reach us, particularly in times like now where we have an increased cost of living and a lot of households are doing it tough. A lot of people have been waiting for these interest rate drops and hoping that they would be the answer to a lot of the struggles that households are facing at the moment. But there's a lot that goes on behind the scenes, or a lot that's going on economically, or a lot that's going on that we may not necessarily think about when we are holding out for these interest rate drops. So today, Rocco's going to go through 5 things that we might not consider are also at play when interest rate drops are happening. And we've had a couple already. We're expecting a couple more. So let's see what's really going on behind the scenes. Number 1, confidence and competition.
We're kind of right in that cycle now of rates starting to come down after they've been pretty high for a while, or record highs, really. So people have really been coming to terms with what does it mean if rates are going to come down, and are things going to get easier for me? And there's a kind of 5 things that I want to talk about that just show what's going on behind the scenes and how that might actually impact markets. So the first one is the confidence and the competition that's starting to come back to especially property. So when we talk about confidence, we mean people's security and appetite to actually go out and borrow money, because obviously that's the biggest thing. They're borrowing hundreds of thousands, if not millions of dollars to be able to get into the property market. They need to be really comfortable with the fact that that's doable for them, that they can actually afford that. So when we start to see rates come down, you might start to see pre-approvals increase. So people go to the bank and they say, hey, how much can I borrow? And they get their kind of pre-approval. But one of the things that you want to be really aware of is how many of those pre-approvals actually end up converting into formal loans, and actually, money is actually changing hands. So you will tend to see an increase in pre-approvals, but especially at the beginning of the rate cut cycle, those pre-approvals, a large portion of them are not converting. And that can be due to a few different factors. One of them is not being sure of when is the right time to buy. Do we buy now because rates have started coming down, or we hear all the chatter about potential 2 more rate cuts, 3 more rate cuts, whatever it might be. So do we wait for that to happen and try and buy then? So a lot of those pre-approvals tend to just be people deciding, okay, I think it's a good time to get back in, but then not being sure when to actually get in. That solid confidence is not there.
Sure.
So they don't end up converting those.
So what are they waiting for? Why aren't they converting?
I think it really is just an inability to know, is this the right time?
And at the bottom.
Yeah, that's right. Trying to catch the bottom. And I think, something that we discuss with our clients quite a lot is not being so focused on buying at the right time.
Yeah.
Because property is such a long-term investment, we really just want to be getting in as soon as we can. Obviously being careful about how we're getting in, where we're getting in, but just getting into the market, and then just making sure you have the right strategy that's going to allow you to hold those properties for a long time, keep growing your portfolio.
And I guess there's a lot of confusion out there. There's so much information, that these people are gathering that they're just lost on what to do and where to, which direction to take, and they just, fall out.
Yeah, of course. There's there's that just inability to make a decision because of so much information or so much uncertainty. One end of the extreme or the other. That they do end up just not doing anything, and they kind of take that first little step and then just let it fall by the wayside. Another thing that kind of plays into it is even just psychology itself. So they might get their pre-approval, start scouting out open homes. They start to see a lot of people coming to these open homes because everyone's kind of got the same idea at the moment. They see that perceived increased competition, and that puts a bit of fear into them as well, and saying, okay, maybe we should take a step back. There's too much here. Whatever the asking price is, it's probably going to go way above that. So They just say, oh, we'll wait a little bit longer. We'll just keep waiting. Maybe rates will come down even more. We'll be able to borrow more. That'll allow us to get an edge on our competition.
Yeah.
Number 2, the RBA is intervening because they are concerned.
So another thing that people was obviously, when they look at interest rate drops, they look at it as a positive thing. They're looking at it as, oh, this is going to help us. But if rates are coming down, it's generally happening because the RBA is worried. Mm. They're worried that the economy is slowing down, unemployment is not going well, maybe inflation's out of control, it's not where they want it to be. So they're intervening, essentially. They're not letting things just run their course. They're saying, okay, we have to step in and do something.
Yeah.
And generally, if they're lowering rates, it means they're trying to stimulate the economy. So we can use the extreme example of the last few years, post-COVID. Rates had to drop. There had to be more money in the market. Okay, and that's generally what we see when rates drop. It gives people more access to be able to borrow.
Yeah.
That extra borrowing translates into more spending, which should theoretically stimulate the economy by, creating increased income for people, more spending, property prices going up, all of that kind of thing. But then on the flip side, it also plays into borrowing costs. So obviously, if borrowing costs are lower, then everything's more affordable, so people are not under as much financial stress as well. And then if you want to take it a step further and look even internationally and how it affects overseas investments, the lower our interest rates are, the less attractive it's going to be for other countries to invest their money into Australia, which means that the value of the Australian dollar is actually going to fall as well.
There, yeah.
So a lot of this is something that we need to think about and saying, okay, theoretically it should be a good time to buy because we can borrow more money now, but we also need to be cognizant of the fact that the economy is not doing as well as it can be doing, and that's why the RBA needed to intervene. So we still need to be really strategic, and it's obviously something that Dragan and I in particular work very closely with our clients on, is making sure that we're understanding their entire structure of how they're going to be accumulating property, so their actual plan, and then where they should actually be buying as well. So it's really important, and Dragan, you can kind of back me up on this, especially during these times when rates are coming down. It is really important to understand where you are buying and why you're buying into that market.
Rocco, that's exactly right. So it's looking for the value and not just the increase of the property rises just because of the interest rates have fallen.
Yeah, absolutely. So, rates coming down, serviceability goes up, people can afford to borrow more. And so they're inevitably going to likely end up paying more for the same thing that they were a few months ago.
Yeah.
And those kind of increases are kind of artificial in a way. There's no real significant value. There's no reason for the value to have gone up.
Yep.
Whereas we want to identify areas where there is actual value. There's demand, there's, infrastructure growth, job hubs, reasons for people to be moving to that area and creating more value.
You talked about value to justify price and be careful of those bubbles that are forming from that serviceability perspective in a falling rate environment. Is there anything else that we need to consider when purchasing in a falling rate environment when looking at affordability as a driving force of price?
Obviously, serviceability is going to have a major impact, and that is going to be what is driving people's borrowing. Can we afford the repayments ultimately? I think people are a lot less worried about how much can I borrow and more so about can I afford the repayments at the end of the day. And obviously serviceability is going to go up when rates start to come down. But at the same time, that is only going to affect the people who can actually borrow. There are a lot of people who can't borrow. So as rates come down, you will tend to see unemployment levels start to rise. So there'll be more people out of a job. And that's obviously going to affect a lot of households significantly, especially today when the cost of living is so high. They're already under a lot of stress. And then it's going to be very difficult for them to handle. And those people are not going to be able to borrow. And not only are they not going to be able to borrow now, when they eventually are in a position where they can potentially borrow, it is going to be that much harder for them to get into the market because the market's probably moved, a couple of 100,000 or tens of thousands. It's significantly moved. So it is almost like you see a lot of people talk about how they're almost stuck on the hamster wheel, and it's just they're just constantly chasing their tail, trying to get onto the property ladder. So when people do finally feel like they're in a position to be able to borrow and say, okay, we can get onto the property ladder now, there's other circumstances in their lives that could potentially put them in a position to not be able to do it. And markets have moved, and then it gets that much more difficult for them to actually get on the ladder.
Yeah. So what does someone do in that circumstance?
Yeah, it's a great question, and it's a difficult question to answer because
it's individual.
It is individual, it's definitely individual, and there is no kind of silver bullet there. There is no kind of secret answer that's going to completely solve the issue. I think the best thing that people can do is obviously just try their best to put cash aside, have some savings behind them to help them get involved. But then even speaking to a professional and understanding what options are. There are a lot more options to get onto the property ladder these days than there used to be, or that people are aware of. That we have a lot of clients that will come to us, and there's that stigma of, okay, if I want to buy an investment, for example, I need my 20% deposit. I don't want to be paying LMI. And it has to be this specific style of loan. But there are so many different examples. We were recently discussing with Mortgage Works about a client that wasn't really able to get the deposit together.
The 20%.
The 20%. But they were a vet, so they were able to fall under the Medico, and there's certain lenders that, if they're in the medical industry, they allow them to use 5 or 10% deposits. So
without LMI.
Without LMI. So, there are options out there that people can potentially look at to be able to get onto the property ladder. And then there's strategies as well. So I know that you've been a big advocate of this, rent vesting. So obviously a lot of people that want to buy want to get into their own home. That's always the goal. But sometimes it can make more sense to, rather than chase your tail and not be able to ever get onto the property ladder, let's get in somewhere and use the market to our advantage. Let's let the market do some of the work for us. And then we can eventually leverage off that to get into where we want to go. So
because eventually that can turn around into a perfect example where it's we had a client a few years ago where they were actually wanting to live in a particular suburb in Sydney. The difference between the growth in Sydney and where we've eventually they ended up still renting, but where we've actually selected a few properties for them with a certain time had outperformed the growth to what they were going to purchase in Sydney, and eventually now they're looking in purchasing in Sydney.
Yeah, absolutely. And it's the difference between if you're able to get into an investment, even if that investment is say 500,000, and a somewhat affordable price point, one can say, and you're able to get a 10% growth, that's $50,000 a year. I know that there are the majority of households, I would say, that would struggle to be able to put $50,000 aside every year as additional savings. So using the market to your advantage to compound your savings, build your equity a little bit faster, can give you that leg up into eventually getting into the house you want, even at a time when it might be more difficult for you to actually afford to get into the market because of some of those conditions that we talked about before.
That's right.
Number 3, asset inflation rises.
So one of the things that we have to think about is asset inflation as well. I'm sure if anybody talks to their parents or an older generation that was, that had property back in the day, they say, "Oh, you guys are spoiled these days. We paid 17% interest rates." But, the average house price might have been $150,000 back then. So 17% on that is relative to 6% on $1 million. It kind of falls within the same category. So we can see that regardless of where the rates have kind of been, inflation has played a part. And usually, if we look at the long-term data, what you'll notice is that as rates come down, that rate of inflation and the rate of prices increasing starts to accelerate. And so that can be kind of, for people that are in the market already, it is a ray of hope. We are likely to see some kind of boom. Prices should increase, and that's just because people will have more access to money, and they can now buy properties that they might not have had access to before. And more competition will be created in the market as well. There'll be people starting to bid against each other, and because they have that access, those prices will start to increase. So there is that kind of level of hope for investors that we are going to go through a boom period. But we need to be aware that that boom period isn't necessarily going to happen straight off the bat. We're not going to get a rate cut today, and tomorrow you're going to see property prices jump by $100,000. There is a kind of lag in the market where things need time to catch up. And that can relate back to even what we talked about in the first point with that confidence and that competition. People are unsure. So even though the rates have started to come down, they're still unsure if this is the right time. They might be starting to test the waters. They might be waiting for a few more rate cuts and try to gauge the bottom, so to speak. And then once that stability is found, maybe if we have a few more rate cuts this year, and then we go through a period where they kind of stay level for a while, and people kind of start to become aware, or they start to become comfortable with the fact that this is the status quo. Things are going to be around this level. They'll have that confidence to really start pouring into the market, and that's when you'll probably start to see those prices start to increase.
Yeah. Okay.
And that's why we want to be strategic about that as well, and say, okay, if we know that that is coming, does it make more sense for us to try and find a deal now, or do we wait for that and be able to borrow more money and then go into that market where there is more competition, but we should have more options available to us? So that there is that kind of give and take on either side, and that's something that we kind of discuss with our clients quite a bit as well. Like I said, clients are always asking us, what's next? What should we be looking out for? What's going to happen? They almost want a crystal ball. And if you've spoken to anybody that's involved in investing in general, they'll tell you, unfortunately, we don't have a crystal ball. If I did, I'd be on a beach in Morocco or something like that. So there is that kind of that expectation that they want to try and gauge what's coming next and take advantage of that. And we've always kind of harked back to, it is a long-term game. We want to be strategic about our portfolio acquisition and our portfolio structure, and also be aware of the fact that rates and conditions are going to change over the years. They're never going to be static. So even after you purchase and throughout the length of time that you hold onto your assets, things are going to be moving up and down. So we don't want to make decisions purely based on those conditions alone, because then you'll be constantly chopping and changing your portfolio, selling assets, buying assets every few years. And that can be a strategy that works for some people. But if we're looking at a long-term buy and hold and kind of trying to get that capital growth out of the market, then that can increase your potential risk as well. Also significantly increases your costs of doing business. There's obviously costs involved with buying and selling.
Yes.
So
strategy costs,
absolutely. So it's definitely something that you want to be aware of. So we want to kind of talk to clients about tempering their expectations of what it is like to actually hold on to an asset through all of the cycles. And when things like this happen and rates do start to come down, we can kind of prime them on what to expect. And if the opportunity makes sense for where they're at in their strategy development, then we can take action during that period, or we can just kind of coach them and guide them through those waves, how to navigate that kind of market environment, and then how to navigate what comes next after that as well.
Number 4, in a rate cut environment, fixed versus variable rates.
So a question we often get is, how should we structure our rates? Should I go variable or should I go fixed? And what are the advantages and disadvantages of both? I think there is a bit of a common belief that variable rates are better, just in general.
And House always wins.
Exactly. So, I think there are situations though where you can take advantage of fixed rates and have that work for you, especially in the context of a long-term strategy. So a lot of times, a lot of rate decisions and a lot of rate conversations that we have with clients, they're very short-term focused. But again, we need to remember that we are going to be holding these properties for hopefully the next 5 to 10 years. Rates are going to change so much over that period of time. And so what it can come back to is saying, okay, what is on a long-term average going to be the most advantageous for us? So one of the things we can look at is when fixed rates are falling faster than variable rates. So we've had a lot of commentary that rates are coming down. The RBA is already putting cuts into the market and discussing further cuts. And so banks are starting to price some of those in, especially in their fixed rates. And when we see fixed rates start to fall, some people will look at it and say, okay, if the fixed rate is higher than the variable rate and we expect cuts, there's no point for us to go fixed. But what happens when the fixed rates are lower than the variable rates? And even though you do expect future rate cuts, does it make more sense to actually lock in that lower rate now and have a potential additional 6, 12, 18 months of that lower rate? And so those cost savings, does that average out to a better long-term financial outcome for you versus banking on the fact that variable rates will be lower, which can change on a dime? You know, we had that kind of the famous commentary from the RBA that they promised us that rates would not be going up, and then within a few years they went up like 4%. So things can change. Things can change very quickly. So if you do have the opportunity to lock in a lower rate that is on the long-term average going to give you a longer period of time of lower repayments, there's definitely a case to be made for seeing how that would fit your strategy and saying, okay, this actually makes sense for our cash flows. It is going to benefit us in the short term. It's going to benefit us in the medium term.
Yep.
And then in the long term, things can change so much that we can just readjust when the time comes.
Yep.
And that'll actually mean a better financial outcome for you.
Okay.
What's your opinion on hedging your bets, so splitting your loan into partially variable and partially fixed?
Yep. That can be a good strategy for people. It'll depend on each individual circumstance. A lot of the times when we talk about things, it's always going to be individual circumstances. So, splitting your loan can be advantageous if your cash flows demand it. So if you are struggling to meet repayments and you need that lower interest rate on a certain split, that can make sense. It also depends on your intentions for those split debts. So, if you have the intention of, for example, let's say you've split a loan, you've got your principal place of residence that has the primary debt on it, and you've taken out some equity to use for an investment. And let's say your intention is, I want to try and pay down that debt that is against my actual home, my non-tax deductible debt, as quickly as possible. So let's leave that one on the variable rate, which allows us that extra flexibility of further repayments, maybe redraw offset accounts, all those types of things. And then the debt that we're going to keep for the long term, your investment debt, which is tax deductible, and you're going to try and squeeze that little bit of extra return out of, can make sense to put that on a fixed rate, lock in your repayments on that so you understand exactly what you're in for on that, whether it's for the next 2, 3, 5 years. And then just put all of your focus on paying down your home mortgage, for example.
I suppose it depends as well on what lenders are willing to offer, because sometimes fixed rate products come with limitations. You mentioned before, you might not be able to pay down as much. They might have an annual limit on how much you can reduce the principal by when you have a fixed interest rate. You might not have access to offset accounts. They might only offer that on their variable products. So again, it requires specialised advice from a broker. But generally speaking, splitting is an option for most people.
Absolutely. Yeah, you hit the nail on the head. So you definitely want specialised advice from a broker. And look, lenders are in general becoming a little bit more lenient with the types of features and products that they offer on their fixed rates, but there are still certain limitations in place. And so you want to be aware of what they are, and does that fit with what you're looking to do with your overall finance structure. So having an overall plan for your finances is pretty important as well when deciding, should I go fixed or variable?
Yeah. And again, like Amanda said, talk to your mortgage broker and
there's a lot to consider.
Exactly.
It's not just a loan, is it? It's a little machine of its own that fuels your portfolio potential.
For sure it is, yeah. And it's a difference between, being average or
being the 1%.
Being the 1% as an investor, property investor.
You know what though? Speaking of the 1%, there's a theory, I'm sure you two have heard of it, where you just have to be 1% better at 100 different things, right?
Yep.
So if your loan structure is 1% better than the next bloke's, or your choice of property is 1% better than the next bloke's, or your choice of buyer's agent is 1% better than the next bloke's, all those little 1% add up.
That's right.
Into a much fuller picture.
Sure does.
You just have to be a little bit better at each thing.
Yeah,
100%.
Definitely.
So that advice is beautiful. Thank you.
Okay.
Number 5, people assume that with rate cuts, we've hit the bottom of the market. But have we?
So most people assume that when rate cuts happen, that's the bottom of the market, it's time to buy. But that's not necessarily the case all the time. Generally what you'll see, and we kind of touched on this before, is there is a reset period or a period of stagnation or a flat market. So you'll tend to see that the confidence needs to slowly build up. People are not going to automatically have that confidence immediately. And it will take some time for prices to start to move. So just because rates have come down doesn't necessarily mean that you need to rush out, get your loans approved and start to invest right away. Markets will tend to go through, like I said, a period of stagnation, a bit of a flat market. And it's important to understand how to make money in a flat market. There is a lot of potential to make money in a flat market, and having a buyer's agent that's experienced in those types of conditions can make the difference. And so that's something that we work with our clients quite a lot on. And so understanding where to buy, when to buy, how to buy, and what to buy as well is quite important in a flat market. But at the same time, you do need to be aware of the risks, because if you do purchase the wrong type of asset in the flat market, that can lead to negative equity, which can be a bit of a false start. It can set you back a little bit in your portfolio growing journey. Something that I'm very big on with my clients, especially from a strategic point of view, is I want to look at each transaction as the next step in building a portfolio. So I never treat a client as a one-off transaction or just looking to purchase one property. I always want to look at it as a stepping stone to be able to build up a large-scale portfolio. And so if we start off with negative equity, so when I say negative equity, I mean that your loans are higher than the value of your house. That prevents you from withdrawing that equity to use as a deposit on the next property, which means that if you want to purchase a new one, you might have to actually save up the cash, which might take you years and years and years to be able to do. And that can obviously stagnate the growth of your portfolio as well. So it is important to understand, like I said, just to recap, important to understand that markets will likely go through a bit of a stagnation period. They will be flat for a while. And working with somebody who has experience in navigating those types of markets can be the difference between a large amount of growth or setting you back possibly a few years towards actually growing your portfolio. So when we're talking about negative equity, I can actually give an example from my own personal experience. So I bought my first property in 2018. I went into, I just wanted to get onto the property ladder. So I bought an apartment here in Sydney. I paid about $438,000 for that. About 2 years after owning that apartment, I decided I wanted to try and buy my next property. And so I started speaking to my broker and understanding what my borrowing capacity was, and then tried to look at what equity I had available to help me with my deposit. Now, in that 2-year period, the apartment market was going through a bit of a slump, so it was actually only worth about $400,000. Now, because of that, and my debt was high, I no longer had enough equity to be able to withdraw. So generally speaking, if the property is, if whatever the value of a property, a bank will lend you up to 80%. Okay. So if it's a $400,000 property, then you're looking at about roughly $320,000 of total borrowing. At the time, I had $360,000 of debt, so I was already above that 80% threshold. So if I wanted to try and borrow, not only would I have to pay I would have to pay $40,000 off that property just to get it back to the 80% level that the bank considers comfortable. So that was a big hamper on me being able to grow my portfolio, because I had to spend an extra year then trying to pay down debt and getting more cash together for another deposit.
Thank you, Rocco, for that insight. Much appreciated. I'm sure the listeners got a lot out of that. Amanda, again, thank you very much. And for everybody out there, thank you very much for listening. For a free consultation, I'll leave a link below. Feel free to book if you have any questions in regards to your journey in investing. And again, thank you very much for listening. And until next time.
The Passive with Property podcast is brought to you by the Buyers Agency Australia.